This is financial entropy, and today we're investigating the systemic decay of cross-border settlement infrastructure and the invisible time gaps that can destroy global liquidity in hours. The collapse happened on June 26, 1974, at precisely 3:30 p.m. Central European Time. A medium-sized German bank named Herstatt became the first domino in what would become the modern architecture of financial contagion. But here's what makes this collapse different from every bank failure before or since. Herstatt didn't fail because of a bank run, a liquidity crisis visible to depositors, or even a traditional credit collapse. It failed in the gap between payment systems, in the 6 hours between when Frankfurt closed its books and New York opened its markets. By that moment, Herstatt Bank had already received Deutsche Mark payments from counterparties across the Atlantic. The dollars they owed in return were scheduled for release when New York markets opened, except New York never received those dollars. The German regulators closed Herstatt's doors at the exact midpoint of the settlement cycle, creating what would later be termed the first documented case of cross-border settlement risk in the floating exchange rate era. The entropy was invisible, embedded in the time zones themselves. The Federal Reserve Bank of New York would later document in their 1976 analysis of payment system vulnerabilities that 40-some American banks were left holding Deutsche Mark obligations with no corresponding dollar receipts. The amounts were significant enough that three institutions faced immediate liquidity crises. But here's the anomaly that opens our investigation. Herstatt wasn't systematically important by the metrics of that era. Its balance sheet totaled roughly 860 million Deutsche Marks, according to German banking supervision records preserved in the Bundesbank archives. That's equivalent to approximately $200 million in 1974 exchange rates. For context, Chase Manhattan alone held assets exceeding $30 billion. Herstatt was a regional player specializing in foreign exchange speculation, not a money center giant. So, why did its failure trigger what the Bank for International Settlements would later classify in their 1996 report on settlement risk as a near systemic event? Why did interbank markets freeze globally for weeks? Why did the dollar Deutsche Mark forward market, the second most liquid currency pair in the world, essentially stop functioning? The answer lies not in Herstatt's size, but in the structure of what it was doing. The bank had built a massive, unhedged foreign exchange book, a portfolio of currency bets that exceeded its capital base by a factor of 30 to 1, according to testimony from German banking regulators presented during the subsequent parliamentary inquiry. Ivan Herstatt, the founder's grandson who ran the institution, had transformed a conservative family business into a proprietary trading operation. The incentive structure was elegant in its simplicity. Foreign exchange profits flowed directly to executive bonuses, while losses remained on the institutional balance sheet. This is the pattern we must understand before we proceed. Herstatt didn't fail because of bad luck or unforeseeable events. It failed because the people making the currency bets were insulated from the consequences of those bets. The traders earned compensation based on gross trading volumes and quarterly profits, not risk-adjusted returns. When you separate decision-making authority from financial consequences, entropy becomes inevitable. The specific catalyst was the Deutsche Mark's appreciation against the dollar through early 1974. After the Bretton Woods system collapsed in 1973, currency values began floating freely for a generation. Herstatt had bet heavily that the dollar would strengthen. Instead, the mark surged 23% in the first 6 months of the year, according to data compiled by the International Monetary Fund in their retrospective analysis of post-Bretton Woods volatility. Each percentage point move represented approximately 20 million Deutschmarks in losses for Herstatt's book. By June, the hole in the balance sheet exceeded the bank's entire capital base. German regulators knew this. Internal Bundesbank memos from May 1974, later published in academic analyses by the Institute for Banking History, show that supervisors had identified Herstatt's foreign exchange exposures as unsustainable. But here's where the incentive structure of regulators comes into focus. Closing a bank is a political decision, not merely a technical one. The regional government where Herstatt operated had close ties to the family, jobs were at stake, and perhaps most importantly, no German bank had failed since the immediate post-war period. Regulators hesitated. That hesitation created the conditions for the anomaly. On the morning of June 26th, the German Banking Supervision Authority finally acted, revoking Herstadt's banking license at 3:30 p.m. local time. This timing was not arbitrary. German markets had closed. European settlement systems had processed the day's Deutsche Mark payments. Herstatt had received roughly $200 million worth of Deutsche Marks from counterparties, expecting dollar deliveries in New York. But when New York's clearinghouse interbank payment system opened at 9 a.m. Eastern Time, there were no corresponding dollars. Herstatt's account at Chase Manhattan, the correspondent bank that handled its dollar settlements, had been frozen by a German court order. The dollars that 40 American banks expected to receive simply didn't exist anymore. They had been paid out Deutsche Marks that morning. They were now creditors in a German bankruptcy proceeding. This is what settlement risk looks like in its purest form. Not credit risk, where you assess whether a counterparty will pay, not market risk, where you measure price fluctuations. Settlement risk is the possibility that you fulfill your obligation, but your counterparty doesn't. Not because they're insolvent, but because the payment systems aren't synchronized. You're exposed during the gap, the hours or days when money is in motion between systems. The Federal Reserve documented in their internal analysis, later cited in congressional testimony about payment system reform, that settlement risk was essentially unmeasured before Herstatt. Banks calculated credit exposures, but they assumed that foreign exchange transactions settled instantaneously. The reality was that settlements happened across multiple time zones, multiple payment systems, and multiple legal jurisdictions. Each of those gaps was a vulnerability. Within 48 hours, the vulnerability became visible. Interbank foreign exchange trading volumes dropped by 60% globally, according to data compiled by the Bank for International Settlements in their subsequent investigation. Banks that had been executing hundreds of transactions daily with dozens of counterparties suddenly pulled back. Every institution was simultaneously reassessing which of their correspondent banks might be the next Herstatt. The discovery process revealed something uncomfortable. Nobody actually knew their settlement exposures with precision. This is the central thesis governing everything that follows. Financial systems fail not at their weakest institutions, but in their invisible dependencies, the structural gaps between systems that appear irrelevant until they activate simultaneously across all participants. Herstatt's collapse revealed that the global financial system had built enormous volumes of activity on top of an unexamined assumption that payment systems in different countries and time zones were effectively synchronized. They were not. The 6-hour gap between Frankfurt and New York was always there. It just took a bank failure at 3:30 p.m. to make it systemically dangerous. Part 2. The Architecture of Disorder. The incentives that destroyed Herstatt Bank were established years before the collapse, embedded in the compensation structures and regulatory frameworks of early 1970s banking. Start with the traders themselves. Herstatt's foreign exchange desk operated under a bonus system that paid out quarterly, based on marked-to-market profits. The Bank for International Settlements documented in their case study of the collapse that senior traders could earn annual compensation exceeding 3 times their base salary in strong years. These bonuses were calculated before accounting for risk provisions or potential future losses. A trader who generated 10 million Deutsche Marks in paper profits by March would receive a substantial payout in April, even if those positions exploded by June. This temporal mismatch between compensation and risk realization is crucial. The traders weren't being dishonest or reckless in any malicious sense. They were responding rationally to the incentive structure. If your compensation is determined by quarterly profits, and if large directional currency bets can generate those profits, the rational action is to increase position sizes. The downside risk accrues to the institution's capital base, which exists in a different temporal frame than your bonus check. Ivan Herstatt understood this dynamic perfectly well. His own compensation, according to documents presented in the subsequent civil litigation by the bank's liquidators, was tied to the institution's annual profitability. He had transformed the bank from its traditional trade finance business into foreign exchange speculation, specifically because currency trading generated higher returns on equity. The margins on trade finance, providing letters of credit and transaction banking for German exporters, had compressed throughout the 1960s as larger banks entered the market. Foreign exchange offered leverage, liquidity, and immediate profit recognition. But leverage is always bilateral. It magnifies gains and losses equally. Herstadt's balance sheet showed total assets of 860 million Deutschmarks at year-end 1973. The foreign exchange book, the aggregate of all outstanding currency positions, totaled approximately 26 billion Deutschmarks in notional value, according to the Bundesbank's post-collapse audit. That's a leverage ratio of 30 to 1 on the speculative book alone. To visualize this, for every Deutschmark of the bank's actual capital, traders had committed the institution to 30 Deutschmarks of currency exposure. A 3.3% move against their positions would mathematically wipe out the entire capital base. In stable exchange rate environments, this might be sustainable, but 1974 was not a stable environment. The Bretton Woods system, which had fixed major currency exchange rates since 1944, collapsed definitively in March 1973 when major central banks allowed their currencies to float freely. This was unprecedented in modern financial history. For a generation, traders had operated in a world where the dollar Deutschmark rate might fluctuate within narrow bands, typically less than 1%, before central bank intervention would restore the peg. Suddenly, those bands disappeared. The Deutschmark appreciated 23% against the dollar between January and June 1974, according to IMF data. This wasn't a smooth trend. There were multi-percentage point swings within single days. Herstatt had positioned for dollar strength, expecting that American interest rate increases would attract capital inflows. The opposite occurred. Oil price shocks from the 1973 embargo created inflation fears, and international investors sought safety in Deutschmarks backed by German manufacturing capacity. Each 1% move represented roughly 260 million Deutschmarks in mark-to-market losses for Herstatt. By April, the cumulative losses exceeded 400 million Deutschmarks, approximately half of the bank's total capital. At this point, the rational action would have been to close positions, realize losses, and recapitalize. But that's not what happened. Instead, Herstatt doubled down. The bank increased its dollar-long positions through April and May, according to trading records later analyzed by German prosecutors. This isn't irrational as it sounds. The traders and executives faced a classic gambler's dilemma: certain ruin if they realized losses versus possible recovery if the dollar reversed. The incentive structure made the gamble attractive. If they were right, they would earn extraordinary bonuses and restore the institution. If they were wrong, they would lose their jobs but wouldn't face personal financial liability for the losses beyond their equity stakes. This is how incentives create inevitable outcomes. People don't make reckless decisions because they're stupid or evil. They make reckless decisions because the incentive structures reward recklessness more than they punish it. Herstadt's traders weren't aberrations. They were rational actors responding to a system that separated authority from accountability. The regulatory incentives created parallel dysfunction. German banking supervision in 1974 was fragmented across federal and state authorities. Herstatt fell under the jurisdiction of both the Federal Banking Supervisory Office in Berlin and regional supervisors in Cologne, where the bank was headquartered. According to internal Bundesbank correspondents published in academic analyses of the crisis, federal supervisors identified Herstadt's excessive foreign exchange exposure as early as March 1974. They requested detailed position reports and expressed concern about the leverage ratios. But closing a bank requires political will, and political will requires overcoming substantial inertia. Herstatt employed roughly 300 people in Cologne. The founding family had deep connections to regional government officials, and perhaps most importantly, no major German bank had failed in peacetime before the Second World War. The precedent of allowing a bank to collapse, even a small one, was itself destabilizing. So regulators did what regulators often do when facing difficult decisions. They delayed. They requested more information. They held meetings with management to discuss remediation plans. All of this was documented in the subsequent parliamentary investigation. The regulators weren't incompetent, they understood the risks, but the incentive structure for regulatory forbearance was powerful. Taking action meant accepting responsibility for the consequences. Waiting meant those consequences might resolve themselves or at least become someone else's problem. This forbearance created the time window for the settlement risk to materialize. Through May and into June, Herstatt continued executing foreign exchange trades with counterparties worldwide. American banks, Japanese trading houses, British merchant banks all entered into currency swaps and forward contracts with Herstatt. Each of these contracts created settlement exposure during the hours or days when one currency payment had been made, but the corresponding payment in the other currency was still pending. The counterparties weren't being negligent. Herstatt was a licensed bank operating under German regulatory supervision. It had been in business for decades. Its failure wasn't publicly visible until the moment regulators revoked its license. This is the fundamental problem with settlement risk. It's invisible in normal times. You only discover your exposure when the counterparty fails mid-settlement. On June 26th, that discovery happened simultaneously for dozens of institutions. The Federal Reserve Bank of New York documented in their subsequent analysis that when Herstatt's dollar account at Chase Manhattan was frozen, there were outstanding settlement obligations to at least 40 American banks. The amounts ranged from hundreds of thousands to tens of millions of dollars. In aggregate, American banks were owed approximately $200 million that would never arrive. But the direct losses were almost irrelevant compared to the systemic impact. Within hours, treasury departments at major banks worldwide began calculating their settlement exposures to all counterparties. What they discovered was uncomfortable. Nobody had been measuring this category systematically. Credit departments tracked whether counterparties were solvent. Trading desks monitored market exposures. But the gap risk, the exposure during settlement, had been assumed away. The response was predictable and devastating. Banks stopped trading with counterparties whose creditworthiness was uncertain. But in a crisis, everyone's creditworthiness becomes uncertain. The foreign exchange market effectively froze. Trading volumes dropped 60% in 48 hours, according to BIS data. Bid-ask spreads, normally a fraction of a percentage point, widened to multiple percentage points. Some currency pairs simply had no active market at all. This is financial entropy in action, not a gradual decline, but a phase transition. The system flips from liquid to frozen because the underlying trust structure has fractured. Every institution simultaneously discovers that they don't actually understand their counterparty risks, and the rational response is to stop trading until that understanding is restored. The Federal Reserve faced an immediate dilemma. American banks were creditors in a German bankruptcy proceeding. German law governed the liquidation. But the frozen foreign exchange markets threatened to cascade into other markets. Corporations that needed to hedge currency exposures for international trade couldn't execute transactions. This threatened real economic activity, not just financial speculation. The Fed's response, documented in congressional testimony from Federal Reserve Chairman Arthur Burns in July 1974, was to provide liquidity to the American banking system and to coordinate with European central banks on temporary foreign exchange facilities. Essentially, central banks stepped in to replace the collapsed interbank market. They provided the currency swaps that commercial banks were no longer willing to execute with each other. This intervention stabilized markets, but it didn't resolve the underlying structural problem. Settlement risks still existed, the time zone gaps still existed, the lack of synchronized payment systems still existed. What had changed was the realization that these gaps could destroy systemically important institutions. Something measurable had escalated. The recognized vulnerability surface of the global financial system had expanded from visible credit and market risks to an entire category of previously unmeasured structural risk. The system hadn't become more dangerous, the danger had simply become visible. Part 3. The 12-hour window. The following analysis is based on available public records and the limited perspective of institutional archives. The mechanics of the collapse reveal how technological and jurisdictional fragmentation can create catastrophic risk. On the morning of June 26th in Frankfurt, Herstatt Bank executed its final foreign exchange settlements. The bank received Deutsche Mark payments through the German banking system, processing incoming transfers from counterparties who had purchased Deutsche Marks forward. These payments settled through the Bundesbank's domestic payment system, which operated during German banking hours, roughly 8 a.m. to 4 p.m. Central European Time. According to the Bundesbank's post-mortem analysis, Herstatt received approximately 400 million Deutsche Marks in settlements that morning. Simultaneously, Herstatt owed corresponding dollar payments to the counterparties who had delivered those Deutsche Marks. These dollar payments were scheduled to settle through the New York Clearinghouse Interbank Payment System, known as CHIPS, which processes dollar transactions during New York banking hours, 9 a.m. to 4:30 p.m. Eastern Time. The 6-hour time difference between Frankfurt and New York created the exposure window. Under normal operations, Herstatt would have received the Deutsche Marks in the morning, European time, then instructed its correspondent bank, Chase Manhattan in this case, to release the corresponding dollars when New York markets opened. The correspondent banking relationship is crucial to understanding the mechanics. Herstatt didn't have direct access to the Federal Reserve's payment systems. Like most foreign banks, it maintained a dollar account at a large American bank, Chase Manhattan in this case, which would execute dollar payments on Herstatt's instruction. At 3:30 p.m. Frankfurt time, roughly 9:30 a.m. New York time, German banking regulators revoked Herstatt's license. The bank's operations ceased immediately. A German court appointed a liquidator who froze all assets, including the dollar account at Chase Manhattan. Chase received notification of the freeze and halted all outgoing payments from Herstatt's account. This created the bilateral failure. Herstatt had already received the Deutsche Mark payments that morning through the German system. Those transactions were final and irrevocable under German banking law, but the corresponding dollar payments, scheduled for release in New York that morning, never executed. The counterparties had delivered Deutsche Marks but wouldn't receive dollars. The Federal Reserve Bank of New York documented in their analysis that Chase Manhattan held approximately $60 million in Herstatt's correspondent account at the moment of the freeze. This was sufficient to cover perhaps 30% of the day's scheduled outgoing payments. The remaining 70%, approximately $140 million, simply didn't exist. Herstatt had been operating on the classic banking principle of fractional reserves, expecting that incoming dollar receipts from other transactions would provide the liquidity to cover outgoing obligations. When regulators froze the account, that liquidity chain broke. For the American banks expecting dollar receipts, the situation was immediately catastrophic. Their treasury departments had already debited the Deutsche Mark payments that morning, expecting the automatic receipt of dollars later in the day. When those dollars didn't arrive, they faced unplanned funding shortfalls. Some institutions had scheduled their own outgoing payments based on the expected Herstatt receipts. The failure created a cascade of settlement disruptions. But the more significant impact was informational, not immediate liquidity. Every bank's treasury department suddenly had to answer a question they hadn't previously considered. What is our settlement exposure to every counterparty? During how many hours or days between when we pay out currency A and receive currency B are we at risk? The calculation revealed an uncomfortable reality. A major bank executing hundreds of foreign exchange trades daily might have settlement exposures to dozens of counterparties, totaling hundreds of millions of dollars at any given moment. This exposure was completely unhedged. There was no market mechanism to insure against settlement risk. Credit default swaps didn't exist yet. The risk was simply assumed to be negligible. Herstatt proved that assumption wrong. Within days, banks began demanding payment versus payment settlement for foreign exchange transactions, meaning neither currency would be released until both had been confirmed as received. But the payment systems couldn't support this operationally. The Deutsche Mark payment system and the dollar payment system weren't connected. There was no technological infrastructure to create atomic transactions that either both succeeded or both failed. The result was a dramatic reduction in trading activity. According to data compiled by the Bank for International Settlements, foreign exchange trading volumes remained suppressed by 40 to 50% for nearly 3 months after the Herstatt collapse. Banks simply refused to trade with counterparties where the settlement risk couldn't be adequately managed. This volume collapse had real economic consequences. Corporations engaged in international trade found it more expensive and more difficult to hedge currency exposures. Import export businesses that relied on forward contracts to lock in exchange rates couldn't access those instruments at reasonable prices. The financial market dysfunction began affecting real economic activity. The silence in trading rooms was measurable. Floor brokers who had spent their careers shouting currency quotes across crowded exchanges found themselves with no counterparties to quote to. The physical sensation of market freeze isn't dramatic. It's the absence of activity. The phones that stop ringing, the quote screens that stop updating, the gradual realization that the market has simply stopped functioning. Central banks responded with what would become the first international financial regulatory coordination effort of the modern era. The Bank for International Settlements convened the Committee on Payments and Settlements in December 1974, specifically to address the cross-border settlement risks revealed by Herstatt. This committee would eventually develop the principles for payment versus payment settlement that underpin today's foreign exchange markets. But the committee's work would take decades to fully implement. The immediate response was simpler and more primitive. Banks just stopped trading with counterparties they didn't trust absolutely. The foreign exchange market fragmented into a two-tier system. Transactions between the largest, most creditworthy institutions continued at relatively normal volumes. Transactions involving smaller or less capitalized institutions essentially ceased. This fragmentation is itself a form of entropy. The market lost efficiency, price discovery deteriorated, the system became less resilient because it was less connected. All of this stemmed from the realization that the technological and legal infrastructure for cross-border settlement actually couldn't deliver on its implicit promise of instantaneous, risk-free exchange. The 12-hour window between Frankfurt's closing bell and New York market operations had always been there. It just took a bank failure to make it visible. And once visible, it couldn't be ignored. If you're finding this analysis of market disorder valuable, subscribe to Financial Entropy for more investigative deep dives. The remarkable aspect of Herstatt isn't what happened, but what didn't happen. Despite the settlement failures, the frozen foreign exchange markets, and the panic among treasury departments worldwide, no major bank actually failed as a direct consequence of Herstatt's collapse. This fact is crucial to understanding why the settlement risk problem remained only partially solved for decades. The direct financial losses were contained. American banks collectively lost approximately $200 million in unpaid settlement obligations, according to Federal Reserve documentation. In today's terms, adjusted for inflation, that's roughly $1 billion. For the American banking system with aggregate assets exceeding $1 trillion, even in 1974, this was absorbable. Three smaller American banks faced temporary liquidity crises when Herstatt's dollar payments didn't arrive, according to Federal Reserve internal communications, later published in academic analyses. The Fed provided emergency lending to cover their short-term funding gaps. None of these institutions failed. Their shareholders suffered dilution when they had to raise emergency capital, but the institutions themselves survived. The containment was partially luck. If Herstatt had been a major money center bank like Deutsche Bank or Dresdner Bank, the settlement exposures would have been an order of magnitude larger. If the failure had occurred during a period of broader financial stress rather than in relatively calm markets, the reduced liquidity in foreign exchange markets might have cascaded into other asset classes. The system came closer to catastrophe than was publicly acknowledged at the time. But the containment was also structural. Central banks responded quickly with liquidity provision. The Federal Reserve, working with the Bundesbank, Bank of England, and Bank of Japan, established temporary swap lines to ensure that dollar and Deutschmark liquidity remained available even as interbank markets froze. This was improvisation crisis management, not a pre-existing protocol, but it was effective. The improvisation became the template. For the first time, central banks had coordinated across borders to address a financial market disruption. The mechanism they developed, swap lines providing foreign currency liquidity, would be reused in every subsequent international financial crisis. The precedent of central bank intervention to replace frozen interbank markets was established. This precedent had profound implications for moral hazard. Banks learned that satellite risk, while real, would be backstopped by central banks in extremis. This didn't eliminate the risk, but it did reduce the private sector incentive to invest heavily in risk mitigation infrastructure. If the central bank will provide emergency liquidity when settlement chains break, why spend resources building elaborate payment versus payment systems? The regulatory response was more systematic, but far slower. The Committee on Payment and Settlement Systems, established by the Bank for International Settlements in December 1974, began the multi-decade project of standardizing cross-border settlement procedures. Their work eventually led to the creation of CLS Bank in 2002, a specialized institution that settles foreign exchange transactions on a payment versus payment basis for major currency pairs. CLS Bank's mechanism is elegant. It operates during a window when both the dollar and European currency payment systems are simultaneously open, roughly 7 a.m. to noon New York time. Counterparties submit their foreign exchange trades to CLS, which nets all obligations and then settles both legs of each transaction simultaneously. If either currency payment fails, neither settles. This eliminates the settlement risk that destroyed Herstatt. But notice the time lag. Herstatt failed in 1974. CLS Bank became operational in 2002. That's 28 years between recognizing the problem and implementing the solution. The answer returns us to incentive structures. Building CLS required cooperation among competing banks, investment in shared infrastructure, and acceptance of reduced flexibility in settlement timing. Each of these imposed costs on individual institutions. The benefits, reduced settlement risk, were diffuse and probabilistic. You only benefit from settlement risk mitigation in the counterfactual scenario where your counterparty fails mid settlement. Absent regulatory mandates, the private sector response was minimal. Banks improved their internal monitoring of settlement exposures, they began demanding collateral from less creditworthy counterparties, but they didn't build the comprehensive payment versus payment infrastructure that would actually eliminate the risk. That required regulatory coordination and mandates, which took decades to develop. The slow response had consequences. Settlement risk remained elevated throughout the 1980s and 1990s. The Bank for International Settlements estimated in their 1996 report that average daily settlement risk in foreign exchange markets exceeded $1 trillion by the mid 1990s. This represented roughly 20% of daily foreign exchange trading volume. For context, that means 1/5 of all currency trades were exposed to counterparty failure during the settlement window at any given time. We don't know how many near misses occurred during those decades because settlement risk problems only become public when they cause actual failures. Several moderate sized bank failures in the 1980s and 1990s involved foreign exchange settlement losses, but none triggered the systemic freeze that Herstatt had caused. This created complacency. The system had adapted just enough to avoid catastrophic failure, but not enough to eliminate the underlying vulnerability. This pattern of incomplete adaptation is central to understanding financial entropy. Systems evolve to survive previous crises, but they don't necessarily evolve to prevent future crises. The banking system after Herstatt was more resilient to settlement risk in German regional banks, but not necessarily to settlement risk in general. The specific vulnerability had been patched, the category of vulnerability remained. Another threshold had been crossed. The financial system had learned that partial solutions to systemic risks could be politically and economically sufficient, even if they remained technically inadequate. As long as no catastrophic failure occurred, the pressure to complete the solution dissipated. The settlement risk infrastructure remained incomplete, not because the problem was unknown, but because the incentive to solve it completely was weaker than the incentive to solve it just enough. Part 5. The Modern Mirror. We need to connect the Herstatt anomaly to your portfolio, your retirement account, your exposure to today's financial system. This isn't historical curiosity, it's a pattern recognition exercise with direct implications for wealth preservation. Start with the basic structure. Herstatt failed because of a temporal mismatch in payment systems, combined with leverage, inadequate regulatory oversight, and misaligned incentives. Every one of those elements exists in today's financial system, often in more complex and less visible forms. Consider cryptocurrency markets. Daily trading volume in crypto markets exceeds $100 billion, according to data aggregated by market analysis firms. Settlement of cryptocurrency transactions involves multiple steps: the trade execution on an exchange, the transfer from the exchange to a blockchain network, and the confirmation of that transfer through blockchain consensus mechanisms. Each step involves tempering gaps and counterparty dependencies. When FTX collapsed in November 2022, customers had deposited cryptocurrency and fiat currency with the exchange, expecting those assets to be available for withdrawal. Instead, FTX had commingled customer assets with its own trading positions through affiliated entity Alameda Research. The settlement exposure, the gap between when customers deposited assets and when those assets could be withdrawn, created losses exceeding $8 billion. The structural parallel to Herstatt is precise. Customers paid in assets on one side of the transaction, expecting to be able to withdraw them on the other side. The exchange operator, like Herstatt, had used those assets for proprietary positions. When those positions failed, the settlement chain broke. Customers who thought they had completed transactions discovered they were actually unsecured creditors in bankruptcy. The cryptocurrency space lacks the regulatory oversight and central bank backstops that eventually contained Herstatt crisis. When settlement chains break in crypto markets, there's no Federal Reserve providing emergency liquidity. The losses are permanent. According to analyses by blockchain forensics firms, cryptocurrency exchange failures have caused cumulative customer losses exceeding $20 billion between 2014 and 2023. But the more significant parallel is in traditional financial markets, where settlement volumes have grown exponentially, while settlement infrastructure has evolved only incrementally. CLS Bank settles roughly $5 trillion in foreign exchange transactions daily, as of 2024. That's a staggering operational achievement. But CLS only handles major currency pairs between participating member banks. Exotic currency pairs, transactions involving non-member institutions, and many types of currency derivatives still settle through bilateral correspondent banking relationships with the same temporal gaps that destroyed Herstatt. The Bank for International Settlements estimated in their 2023 report on foreign exchange settlement that approximately 30% of daily foreign exchange volume, roughly $2 trillion, settles outside the payment versus payment protections of CLS Bank. That's $2 trillion daily exposed to the same settlement risk that caused the Herstatt crisis. The system hasn't faced a scenario where a major foreign exchange dealer fails mid-settlement during a broader market stress. The mathematical reality is uncomfortable. Foreign exchange markets operate with leverage ratios that would have been inconceivable in Herstatt's era. Major dealers commonly maintain net exposure to market risk of perhaps 1 to 2% of their gross notional positions, but their gross positions can exceed their capital bases by factors of 50 to 100. According to data from regulatory filings, the top 5 American banks have combined foreign exchange trading positions with notional values exceeding $30 trillion against combined Tier 1 capital of roughly $1.2 trillion. That leverage is profitable and generally sustainable because currency markets are deep and liquid. But the leverage also means that multi-percentage point moves in major currency pairs, the kind of moves that occur during financial crises, can exceed bank capital bases quickly. We saw this during the Swiss franc depegging in January 2015, when several currency brokers failed within hours after the Swiss National Bank unexpectedly allowed the franc to appreciate. The brokers had leveraged client positions that couldn't absorb the sudden price move. The settlement risk compounds market risk. A bank facing large mark-to-market losses on foreign exchange positions might normally be able to unwind those positions over hours or days, limiting the damage. But if counterparties become concerned about that bank's solvency, they may refuse to settle new transactions, freezing the bank's ability to exit positions. This is the dynamic that accelerated Herstadt's collapse. Once Deutschmark positions moved against the bank, unwinding those positions required counterparties willing to take the other side. When word spread that Herstatt was in trouble, those counterparties disappeared. Today's foreign exchange market is far more concentrated than in Herstadt's era. The top 5 dealers account for roughly 60% of all foreign exchange trading volume, according to data from the Bank for International Settlements. This concentration creates efficiency, but also systemic risk. If one of those top 5 dealers faced a Herstatt-style failure, the settlement disruptions would affect hundreds of billions of dollars in daily transactions. The regulatory infrastructure to prevent this isn't obviously sufficient. Foreign exchange dealers are subject to capital requirements, stress testing, and resolution planning, but these regulations are designed primarily to address credit risk and market risk. Settlement risk remains a secondary consideration in most regulatory frameworks. Banks calculate settlement exposures in their internal risk models, but those calculations aren't typically subject to the same rigorous regulatory oversight as credit or market risk. You likely don't have direct exposure to foreign exchange settlement risk, but you have indirect exposure through every financial institution in your portfolio. If you hold bank stocks, you're exposed to the possibility that one major settlement dealer causes a liquidity crisis that cascades through the banking sector. If you hold mutual funds or ETFs, those funds hold bank stocks and bank debt. More broadly, settlement risk is a category that extends beyond foreign exchange. Security settlement, derivatives clearing, cryptocurrency transactions all involve temporal gaps between when obligations are incurred and when they're finally discharged. Each of those gaps is a potential vulnerability. The system has evolved to manage these risks under normal conditions, but normal conditions are not a permanent state. The Herstatt collapse demonstrated that settlement risk can transform from theoretical to catastrophic in hours. The 6 hour gap between Frankfurt and New York, which had existed since the invention of time zones, became systemically dangerous the moment a bank failed mid settlement. Today's financial system has similar gaps embedded throughout its infrastructure. They're invisible until they're not. The deeper pattern is about systemic evolution. Financial systems adapt to prevent the last crisis, not the next one. After Herstatt, we built CLS Bank to mitigate foreign exchange settlement risk in major currency pairs. That was the lesson regulators learned. But the next crisis might come from cryptocurrency settlement risk, or derivatives clearing risk, or some other category we haven't adequately addressed. The system is always fighting the last war. This is financial entropy in its truest form, not the decay of individual institutions, but the decay of the system's ability to recognize and address new categories of vulnerability. We know settlement risk is real because Herstatt taught us that lesson, but we're not necessarily watching for the settlement risks that don't look exactly like Herstatt. Part 6. The disorder we inherit. The Herstatt Bank collapse on June 26, 1974, created a regulatory architecture that still shapes global finance 5 decades later. The Committee on Payment and Settlement Systems, the CLS Bank infrastructure, the International Coordination of Bank Supervision all trace their origins to that single day when a medium-sized German bank failed at precisely the wrong moment in precisely the wrong way. But the architecture we built was designed to prevent Herstatt-style failures, not to prevent settlement risk in general. This distinction matters because financial innovation constantly creates new types of settlement exposure faster than regulation can adapt. Consider the current structure of the cryptocurrency market. Billions of dollars in stablecoin transactions settle daily through a network of cryptocurrency exchanges and blockchain protocols. Stablecoins like Tether and USDC claim to maintain one-to-one backing with dollar deposits. Users treat these instruments as equivalent to dollars, using them to settle transactions, hold balances, and move money across borders. But the settlement chain for a stablecoin transaction involves multiple dependencies. The stablecoin issuer must actually maintain the dollar reserves backing the tokens. The blockchain must successfully process the transaction. The exchange must credit the recipient's account. Any break in this chain creates settlement risk. We've already seen failures. Terra USD, a stablecoin that maintained its dollar peg through algorithmic mechanisms rather than actual dollar reserves, collapsed in May 2022. Within 72 hours, $45 billion in market value evaporated. Users who thought they held dollar equivalent assets discovered they held tokens whose value had gone to essentially zero. The settlement chain had broken at the most fundamental level. The assets backing the tokens never actually existed in the form users expected. The regulatory response has been fragmented and incomplete. The United States still lacks a comprehensive federal framework for stablecoin regulation. The European Union's Markets in Crypto Assets regulation, implemented in 2024, creates standards for stablecoin reserves, but compliance and enforcement remain uncertain. We're essentially in the early 1970s of cryptocurrency settlement risk. The vulnerability is visible to anyone looking carefully, but the regulatory and technological infrastructure to address it comprehensively doesn't exist yet. This creates asymmetric exposure for investors. Sophisticated market participants understand stablecoin settlement risks and structure their exposures accordingly. They diversify across multiple stablecoins, limit balances held on exchanges, and maintain exit strategies. Retail participants often lack this understanding. They treat stablecoins as equivalent to bank deposits without recognizing that stablecoins lack deposit insurance, regulatory oversight, and central bank backstops. The pattern repeats in securities settlement. Most equity trades in the United States settle through the Depository Trust and Clearing Corporation with a T+2 settlement cycle. You buy stock on Monday, and the transaction finalizes on Wednesday. During those 2 days, you have counterparty exposure to the clearing system and ultimately to the broker-dealer that executed your trade. This settlement lag is invisible under normal conditions, but becomes critical during broker-dealer failures. We saw this with Lehman Brothers in 2008. Lehman's bankruptcy filing on September 15th created immediate questions about outstanding securities transactions in various stages of settlement. Customers who had executed trades through Lehman but hadn't yet received their securities or cash proceeds faced the same fundamental problem as Herstatt's counterparties. They had fulfilled their obligations, but the counterparty had failed mid-settlement. The resolution took months and involved complex bankruptcy proceedings. The Depository Trust and Clearing Corporation's default management protocols helped contain the damage, but customer assets were frozen for extended periods while administrators determined which transactions had completed and which remained open. This was Herstatt's 12-hour settlement window, extended to months. The regulatory response was to strengthen clearinghouse default management protocols and increase capital requirements for broker-dealers. These are valuable improvements, but they address broker-dealer solvency, not settlement risk in its purest form. The 2-day settlement window still exists. The counterparty exposure during that window still exists. We've just made it less likely that the counterparty will fail. This is the fundamental limitation of the post-Herstatt regulatory architecture. We've made specific categories of settlement risk less probable through better capitalization, improved monitoring, and enhanced default management. We haven't eliminated the temporal gaps that create settlement risk in the first place. Those gaps are embedded in the technological and operational structure of financial markets. Real-time gross settlement where transactions complete instantaneously with no temporal gap is technologically possible, but operationally complex and expensive. Central banks use real-time gross settlement for high-value interbank payments, but extending that infrastructure to securities trading, foreign exchange transactions for all currency pairs, and cryptocurrency markets would require massive investment and coordination. The private sector has limited incentive to make that investment absent regulatory mandates. Settlement risk is a systemic problem, but it manifests as idiosyncratic losses for individual institutions. Your bank faces settlement risk from its counterparties, but the probability that any specific counterparty fails mid-settlement is low.
The expected value of the risk is modest compared to the cost of eliminating it entirely. So, banks invest in monitoring and management, but not in comprehensive elimination. This creates what economists term a coordination failure. Every institution would benefit if everyone eliminated settlement risk simultaneously, but no individual institution has sufficient incentive to bear the cost of elimination unilaterally. The optimal outcome requires coordination, and coordination requires regulation or some form of collective action problem solution. We're 50 years past Herstatt and still haven't fully solved this coordination problem. CLS Bank represents partial solution for a specific market, foreign exchange, but that solution took 28 years to implement and still covers only a portion of foreign exchange trading. Extrapolating that timeline to other markets suggests we're decades away from comprehensive settlement risk elimination, even in traditional financial markets, let alone cryptocurrency and other emerging asset classes. This is the disorder we inherit. Not chaos, not collapse, but persistent structural vulnerability. The system functions reliably in normal times, but contains embedded fragilities that can activate rapidly when conditions deteriorate. These fragilities are known and even understood by regulators and sophisticated market participants. They persist because eliminating them is expensive, difficult, and requires coordination that our institutional structures struggle to achieve. For investors, this means the baseline risk in financial markets is higher than standard models suggest. Value at risk calculations, stress tests, portfolio optimization models almost universally treat settlement risk as negligible or ignore it entirely. The historical data supports this. Settlement failures are rare, but rare is not the same as impossible, and the impact when settlement chains break can be catastrophic. The Herstatt precedent established that central banks will intervene to prevent settlement failures from causing systemic collapse. That's valuable knowledge, but intervention is not the same as prevention, and intervention sometimes comes with costs to market participants. Lehman's customers eventually recovered most of their assets, but the recovery took years and involved substantial legal costs. Herstadt's counterparties recovered pennies on the dollar. The modern financial system is simultaneously more resilient and more complex than the system that failed in 1974. The complexity creates new categories of settlement risk that regulators are still learning to identify. The resilience comes from central bank willingness to intervene, but that willingness itself creates moral hazard that can amplify future risks. We're caught in a cycle where each crisis teaches us about a specific vulnerability. We build infrastructure to address that specific vulnerability, and financial innovation creates new vulnerabilities faster than we can address them. This isn't a failure of intelligence or effort, it's an inherent characteristic of complex adaptive systems. The system evolves, but evolution is always reactive, responding to past selective pressures rather than anticipating future ones.
Part 7, the permanent gap. The mystery we opened with has a resolution, but not a comfortable one. Herstatt Bank destroyed global foreign exchange liquidity, not because it was large or systemically connected, but because it failed in the gap between payment systems. The 6 hour window between Frankfurt and New York was always there. Every bank had always been exposed. But the exposure was invisible until someone failed precisely at 3:30 p.m. Central European Time, after receiving Deutsche Marks in Europe but before paying dollars in New York. The central thesis holds. Financial systems fail not at their weakest institutions, but at their invisible dependencies. Herstadt's collapse proved that enormous volumes of financial activity had been built on an unexamined assumption about settlement synchronization. That assumption was wrong. Once proven wrong, it couldn't be unproven. The entire structure of cross border finance had to be rebuilt around the acknowledgement that payment systems in different jurisdictions aren't synchronized. But here's what 5 decades of post Herstatt evolution teaches us. We rebuilt the structure to address the specific gap we discovered, not to eliminate gaps in general.
CLS Bank closes the settlement risk window for major currency pairs. It doesn't close settlement risk in exotic currencies, cryptocurrency transactions, security settlement, or derivatives clearing. Those gaps remain. The pattern is consistent. Each financial crisis reveals a specific category of invisible dependency. Regulators and market participants respond by building infrastructure to address that specific dependency. But financial innovation and system complexity constantly create new dependencies faster than we can harden the old ones. The system is always fighting the last war while the next vulnerability incubates unseen. For your investment strategy, this pattern has practical implications. Recognize that counterparty risk includes settlement risk. When you hold assets at a financial institution, you're exposed not just to the possibility that the institution becomes insolvent, but to the possibility that it fails while holding your assets in an unsettled state. This is lower probability than credit risk, but potentially higher impact because settlement failures can freeze assets for extended periods. Understand that settlement risk concentrates in specific market structures. Assets held in traditional brokerage accounts with established clearing systems have relatively low settlement risk because those clearing systems have been hardened through decades of evolution and regulatory oversight. Assets held on cryptocurrency exchanges or in new financial technology platforms have higher settlement risk because those platforms lack the institutional maturity and regulatory oversight of traditional systems. Except that diversification includes diversification of settlement mechanisms. Holding some assets in physical form, whether precious metals, real estate, or other tangible stores of value, eliminates counterparty and settlement risk for that portion of your portfolio. These assets may have lower expected returns than leveraged financial instruments, but they also have lower tail risk because they can't be frozen mid settlement. Pay attention to market structure during stress periods. The Herstatt crisis manifested as a sudden freeze in foreign exchange markets when settlement risk became visible. Future settlement crises will likely manifest similarly as a sudden withdrawal of liquidity in markets where participants realize they don't understand their counterparty exposures. Recognizing this pattern early provides an opportunity to reduce exposure before the crisis fully develops. The observable systemic risk signal today is the growing gap between settlement volumes and settlement infrastructure capacity. Daily foreign exchange volume exceeds $7 trillion. $2 trillion of that settles outside payment versus payment systems. Daily cryptocurrency volume exceeds $100 billion. Most of that settles through exchange systems with minimal regulatory oversight and no central bank backstop. Security settlement still operates on multi-day cycles despite technological capacity for real-time settlement. Each of these represents a category of structural vulnerability that could activate rapidly under stress. The defensive awareness behavior is to understand the settlement chain for every material asset you hold. Where does this asset actually exist during the hours or days between when you think you've bought it and when you have irrevocable ownership? What counterparties are in that chain? What happens if one of them fails mid-settlement? These aren't comfortable questions, and for most mainstream financial assets held at established institutions, the answers are reasonably reassuring. But the questions themselves are worth asking because they force recognition that settlement isn't instantaneous and the gap creates exposure. The broader lesson is about systemic humility. The financial system is robust to known risks, the ones we've experienced before and built infrastructure to manage. It's fragile to unknown risks, the categories of vulnerability we haven't identified yet or don't fully understand. Settlement risk in 1974 was an unknown risk. We know about it now, and we've built infrastructure to manage it in foreign exchange markets. But we've probably created new categories of unknown risk through financial innovation and increasing complexity. This isn't an argument for financial nihilism or for avoiding markets entirely. The system works reliably most of the time, and market participation is essential for long-term wealth accumulation. But it is an argument for defensive positioning, for maintaining awareness that the system's apparent stability is built on foundations that can shift rapidly when underlying assumptions prove incorrect. The Herstatt Bank collapsed because everyone assumed settlement risk was negligible until it wasn't. What assumptions are we making today that might prove similarly incorrect? What settlement chains do we treat as reliable that might break under sufficient stress? We won't know the answers until the next crisis reveals them, but knowing that we don't know is itself valuable information. It creates the mental space to recognize when invisible dependencies are becoming visible, when gaps that seemed irrelevant are starting to matter, when the system is transitioning from stable to fragile. The hour of chaos that began on June 26, 1974, created the architecture we still inhabit. But architecture designed to prevent the last crisis doesn't necessarily protect us from the next one. The gaps remain. They're just in different places now. Some we've identified and hardened, others we haven't discovered yet. The cycle continues. Systems fail at their invisible dependencies. We discover the dependencies, we harden them, new dependencies form. The entropy doesn't reverse. It just migrates to new locations in an increasingly complex structure. At Financial Entropy, we analyze historical patterns to understand modern risks. Hit the bell to track the disorder with us.